Hello and welcome to DMCA Advisory Should Have, Could Have, Didn't Talk. My name is Jared and we've got some expert speakers for you lined up today. If you'd like to look out for the index page, you'll be able to look for your topic of interest and be able to fast forward to that. We hope you enjoy our talk today.
I'm Tanya from DMCA Advisory, and I'm here just to share a little bit with you about property, everything property. So the first things I'll talk about are the downsizer contributions, because that's actually a big benefit for people over 65. I'll talk about the first home super saver scheme, catch-up concessional contributions, which is something that's just kicked in to effect from 1st of July, and also talk about claims on investment property as well. Okay, the downsizer contribution. So basically how this works is that it's allowing people, it's actually encouraging older Australians to sell their home and downsize. The reason being is a lot of people have had a lot of wealth tied up in a property. So you hear the story about $1 million property that a retiree owns and then they go and claim the age pension. So this scheme is aimed at trying to help people or encourage people to sell down these larger or wealthier homes. And then what that does is it means that, okay, they're using some of that equity in their property to provide for their retirement. So the key thing with this is that you need to be 65 years or more at the time of making the contribution. And of course you need to have sold a principal home. The interesting thing with this is that it doesn't necessarily have to be a home that you were living in at the time you sell it. As long as you've owned that home for at least 10 years and you've sold it after July 1, 2018, basically it can actually be included or be eligible to make this downsizer contribution. So what I mentioned there before about not actually having to live in the home at that time, the key thing with it is that maybe you lived in the home 3 years ago and you've moved away. If that home has been rented out for that last 3 years, that's fine. As long as that home's been owned for at least 10 years, then that's really the key. In relation to the super contributions, so you can contribute up to $300,000 each. So as an individual, that's one lot of $300,000, or as a couple, you can each contribute $300,000. The important thing there is that if you've only sold the home for $500,000, or $500,000 is your limit then. But if you sell your home for $1 million, you can then go and put $300,000 each maximum in. The important thing there too, which is where the benefit really comes in, is that it doesn't matter, it doesn't cover off on any contribution caps or anything like that. Your super balance at the time doesn't matter, so it's actually over and above anything that you might have otherwise had limits on before. It does count towards that 1.6 million amount later down the track when you do actually start to draw on your money in retirement. But importantly, at the time of making the contribution, there's no caps at all, so which is a good thing. So by all means keep that in mind, because I think it's very beneficial for people. Okay, another thing that's come into play, the First Home Super Savers Scheme. Now this is something that effectively you could start from July last year, but really I think it's been underplayed a lot, because I think there's a lot of benefits there, particularly for the younger people wanting to get into their first home, which is what it's designed for. So really the way it works is that if you make a voluntary concessional contribution into super, so that can either be through a salary sacrifice arrangement if you're employed, or it could be that you just put a lump of money in, so you've got some savings set aside that perhaps you were saving up for your first home, a deposit. You can actually make a contribution of up to $15,000 in 1 year and get a tax deduction for it. You can either make $15,000 in 1 year, or you can make $30,000 across a number of years. So $30,000 is the upper limit in terms of those contributions. So what happens is when that contribution goes in, yes, you get a tax deduction, which is great, so you're getting a tax saving straight away. When it goes into the fund does pay tax at 15% on the contribution, which is standard for any concessional contributions. So when you're ready to buy your first home, so you make an application to the super fund, you pull the money out, so it'll be, if you have gone with the maximum $30,000, it'll be the $30,000 plus a deemed earnings rate, which I think is around about 4.2% at the moment. Good thing with that is it doesn't matter, like if your funds actually perform really well, and let's say you've had a return of 8% on that money, well that extra just stays within the fund, which is an added benefit. But essentially you draw the lump of money out plus that deemed earnings. There will be, it'll be taxed at your marginal rate, but then there'll be an offset of 30%. So effectively that's just taking into account the tax benefit you've got when the money went in the first place. The key is though that you can't just take that money out and not then buy a house. So you've actually got to buy your house within 12 months from making that withdrawal. There is some circumstances, I believe, where you can actually extend that to 24 months, but you actually have to make an application to the tax office to do that. And you do actually have to live in the home. You can't just go and buy an investment property either. So that's the other important thing. And so how that works is, let's say you buy a home and you decide that you live in it for 6 months and then rent it out, then that's probably okay, but it's just being aware that there's certain criteria you need to meet when you do buy that house. Okay, another one that's really handy, and I'll mention this one in conjunction with property because there's some strategies that you can utilise with it. So we've got our catch-up concessional contributions. Thankfully this has stayed now that the Liberal government has come into play, because if Labor got in they were going to take this one away. But what it's aimed at is allowing people to catch up contributions in years when, so we know we've got a $25,000 cap on how much we can put into super and get a tax deduction for it. And in that $25,000 that includes the 9.5% that an employer will put in. But let's say for example in 1 year we haven't got the cash to put in that top up extra contribution up to $25,000. But next year we sell a property and we've got some cash available. We can actually bring back where we didn't claim a deduction last year. Let's say we had $15,000 room left up to the $25,000. That $15,000 can come forward to this financial year and be included with the $25,000 cap we have this year. And where that can be good for property sales, for example, is if you've got an investment property that you sell and there's a large capital gain, you can use that catch-up contribution from last year to boost the tax deduction you can have from putting that extra money into super this year, which can help to offset any capital gains that you might make on property. So that's where that relates to the property side of things. The whole catch-up concessional contributions is aimed at, I guess, people that are starting out late, haven't had the cash early on to be able to make those extra contributions, and it's only aimed at people that have a balance of less than $500,000 in super. So you don't have this available to you if you do have more than $500,000 in super. So that's where I think that will be a very good strategy going forward, and one that can be planned for down the track. Now the final thing just in relation to properties is just to recap on a few important facts. This is actually an area that the tax office is scrutinising quite a bit to make sure people are not claiming expenses that they shouldn't. So number one is, of course, always keep receipts for any deductions you're claiming related to the property. So that includes things like if you're making improvements or repairs or water rates, council rates, all of those sorts of things. Just keep a record. The other important thing as well, it might sound obvious, but the property does actually need to be genuinely available for rent. So with the holiday home where you don't intend for anyone to ever stay there, that's not good enough just if it's not listed with an agent, for example, or not advertised as being available. You can't then go and claim deductions for those and then only rent it out for 2 weeks a year and use it the rest of the time. It does actually have to be genuinely available for rent. The other thing which the tax office have knocked out is that you can't claim deductions for travelling to the property to inspect it or maintain it anymore. So this was a big thing, I think, where this has come in, is where people had a property, say on the Gold Coast, travel from Adelaide to the Gold Coast to invest or to inspect the property and maintain it, and then claim that travel as a tax deduction against the property. But it can also cover things like driving to the property, where people are claiming cents per kilometre travel to go and inspect the property. So that's something that's no longer available, unfortunately, but just making that point clear. And the final thing is just making that distinction between expenses that are for genuinely maintaining the property, as opposed to where you go and do something like renovate the property to improve its capital value. So if you do that, that's a cost that can be deducted but over a number of years based on the life of that capital improvement, versus repair, let's say painting, or you have to repair a roof or something like that. That is a genuine deduction, but if it is that, let's say a roof for example, if you want to replace the roof and then put a whole brand new thing on, completely different to what was there before, then that will be a capital improvement. But it's always something that's important just to have the distinction between the two. Well, that's all for property. I'll now hand you over to Chris.
Thank you, Tanya, for that. Very interesting indeed. So maybe from my side, I'd like to cover off on concessions at all income levels. Topics that we'd like to cover off on is obviously the government co-contribution, the spouse contribution, most common, the personal contributions that we can make, and last but not least, insurances within superannuation. Now, starting off, government co-contribution, what is it? So essentially the government says that for every $1 of after-tax contribution that you make, so that would be a non-concessional contribution, a contribution we don't claim a tax deduction for, they will contribute 50 cents over and above your contribution towards your superannuation. Now, the maximum eligible contribution for that is $1,000, which means the government would contribute a maximum of $500 towards your superannuation per financial year. Now, in order to qualify for that, we need to fall within certain income thresholds. So the lower threshold of that being for the 2019-2020 tax year is $38,564. So if we fall below that income for the financial year and we contribute $1,000, the maximum government co-contribution would be $500, or 50 cents for every $1 that we contribute. Now, that co-contribution the government makes tapers down slightly the more we earn. So the contribution bottoms out at $53,564, after which we don't qualify for the co-contribution anymore. And the consideration here really is choosing whether to contribute on a concessional basis, so i.e. claim the tax deduction, or rather go with contribute non-concessionally, so don't claim the tax deduction, but get the government co-contribution. Following on from that is really the spouse contribution. So spouse contribution, what happens here is we are able to contribute on our spouse's behalf towards their superannuation and claim an 18% tax offset. So that would basically mean you'd get 18% back of the contribution that you make. So at $3,000, that would equate to $540. Now, what we have to consider here is that our effective tax rate is over and above the 18%. And considering that we have maxed out our concessional contributions to make sure we're not shortchanging ourselves there. So what is the purpose of the spouse contribution? Well, we're able to boost our non-working spouse's superannuation balance, and we're able to claim a tax offset on our income once we have maximized our concessional contributions. Then lastly, when it comes to super contributions, and it's probably the most popular of them all, is personal contributions. So each financial year we're allowed to contribute $25,000 worth of concessional contributions towards our superannuation. Now, these $25,000 include the employer super guarantee of 9.5%, and over previous years we were able to salary sacrifice the balance up to the $25,000 concessional contribution cap. Now, what we can do is, instead of salary sacrificing, we are able to contribute these funds as a personal contribution. Now, the timing thereof can be within the financial year. So what that means, we don't have to contribute each and every month, but we could actually delay the contributions, save them, let's say, in a cash account, and make those contributions prior to financial year end, so i.e. before 30th of June, into our superannuation. Now, the important part here is that we don't breach the $25,000 contribution cap, so we have to consider what the employer has contributed on our behalf, as well as the personal contribution that we've made, and really importantly is that we lodge our intention to claim a tax deduction. So if we don't let our superannuation fund provider know that we're intending to claim a tax deduction, they will not let the ATO know, and we won't qualify for the tax deduction. So it's really important that we lodge that form and that our super fund provider is aware of the fact, and that they submit that information to the ATO, obviously, and then at that point the ATO can reimburse us for our contributions. Good. Then moving on to the next topic really is insurance within super. Now, This is something we hear about. A lot of our industry super funds offer insurances with superannuation, and for those of us who have a insurance policy outside of an industry superannuation fund, we might also have some of our cover within superannuation. Now, the big thing to consider here is the cost of insurance within super. So when insurance is held within superannuation, we don't really see the premiums going out of our bank account. We are still paying for that cover though. The nice part about it really is that whatever premiums are paid within superannuation are taxed or tax deductible expense to the fund, and they don't come out of our after-tax earnings. What's important though to consider is what type of cover is held within superannuation. And what I'm referring to specifically here is that when an insurance claim is made and we qualify for a claim, that cover is paid within the superannuation realm. Now certain benefits, for instance income protection, the insurance, we might be able to claim from an insurance perspective, the funds pay out to the superannuation fund, but we have not met a condition of release. So what that means is the funds cannot be paid to ourselves as beneficiary and are stuck within the superannuation environment. Now that's something we don't want, and therefore it's quite important to ensure that whatever cover we do take out within superannuation, if a valid claim is made and the funds do pay out, that those can be passed on to us as the beneficiary of the superannuation fund. The next thing we have to look at, especially when it comes to our life cover, is the treatment of the beneficiary of the superannuation fund. So for tax dependents, money is paid out tax-free out of super. So that's the optimum scenario. However, for non-tax dependents, funds are taxed when they come out of superannuation. So not saying that that's the wrong way, we just need to be aware of the fact that the cover amount will be reduced due to the tax that needs to be paid for the funds to be released out of the superannuation environment. So overall, it's really important to make sure that depending what cover we hold and what the intention of that cover is to consider, do I want to hold that cover within my superannuation or outside of superannuation, and what are the tax implications for me in terms of claiming a tax deduction on the contribution, be it in my personal capacity or within the superannuation environment.
Hi, it's Ricardo here. As discussed, I'll be discussing today some gifting and hidden traps and planning opportunities. So some of the things that we'll have a chat today is receipts and tax deductions, gifting limits and deeming, and general deduction claims as we discuss this topic today. In particular, one of the things that I'd like to highlight, and it's becoming quite popular, is people making donations using something like GoFundMe or other crowdsourced donation sites. Now, one hidden trap there is in order to be able to receive a tax deduction for those donations, you need to be making a tax deduction to a deductible gift recipient. So there are registration that need to be made by these entities in order to be able to solicit tax deductible donations to them, and certainly a lot of the ones that are on GoFundMe won't quite meet the registration requirements. Another thing to look out for is if you're uncertain in terms of who you're going to be giving to and you want to get that certainty, feel free to jump on the ABR site and do a search on the ABN of the potential recipient who you intend to give or who you are currently donating, and on that site it will actually give you a summary whether they are a deductible gift recipient on the bottom. So that's a nice handy tip to keep in mind, and in terms of putting together your tax records for us so that we can claim your tax deductions when it comes to your donations. Another thing as well as a planning opportunity is often we see a husband and a wife, and one on a higher income than the other, and it could be vice versa these days. But certainly when making donations, try to make sure that you make the donation in the particular individual with a higher tax rate to get a better benefit out of it. So for example, you might have a spouse who may be a stay-at-home mum or dad who's not currently working. They're underneath the tax-free threshold, so therefore any donations that they make will actually miss out essentially on any tax benefit, as opposed to if that donation was made by their spouse. So that's a nice little one there to look at your arrangements and just make sure you get that into practice. Also, when it comes to bucket donations, now in terms of funding for the bushfire appeal or the flood appeals, as that have been quite common, with natural disasters occurring more and more these days, and a lot more of these donations going through. The good news is that you don't need a tax receipt if you're claiming up to a $10 amount per year. So as long as you've made a $2 donation to these sorts of causes or more, then certainly feel free to jot that down on the information that you provide, and you can certainly get a tax deduction on that basis there. So we'll also discuss in terms of, quite often we get questions, is there a limit to how much I can gift? Well, under the tax system there is no limits in how much you can gift, but certainly there is no gifting tax as occurs in some countries. But one thing to be mindful of is it could affect your eligibility to some social security benefits, such as the age pension. Now, how does this occur? Well, there are certain caps in terms of what you can gift without necessarily compromising some calculations towards the asset base leading up to receiving an age pension, or income being deemed per your assets. And these limits are $10,000 per year, and now this amount actually is inclusive for a couple, so regardless of whether you gift some funds, as a couple it's a $10,000 combined per year with a $30,000 limit over a 5-year period. So be mindful of that. Again, this is an area where we can see that there are some fantastic planning opportunities leading up to becoming eligible for these things, and gifting should be planned with a thorough plan. So certainly feel free to speak to one of our specialists in the DMCA Wealth Solutions team, and they can certainly help you out if you are essentially wanting to gift potentially to your children as you head towards retirement. Okay, now I'll be discussing the topic of keeping adequate record keeping for making your tax claims. Now, it is a bit of a dry topic, so my apologies, but it is a necessity when it comes to making claims through the tax system. Now, essentially, the tax office are really coming and focusing on work-related expenses, as they believe that many taxpayers are actually getting their work-related expenses claims incorrect. Now, in order to protect yourself against this and the compliance that there will be associated with this, with potential audits and reviews in the very near future, is we suggest that you do definitely keep adequate records. So what are adequate records? These include your original receipts for any tax deductible items, and certainly there are some tax deductions in the tax legislation that don't require receipts, such as if you're claiming a work-related car under the cents per kilometre method, or you may be claiming some home office expenses based on an hourly use of doing some work from home, or it could even be your laundry expenses, which was a target of last year's compliance in terms of how many washes that you do. Certainly when making these claims, even though there's no need for your original receipts, there is a need to keep adequate records, or maybe some diary entries in regards to the trips that you've made, or how many washes you've done per week, and so forth, just to back up the claim. In the event that the tax office review these claims and there's no sufficient records in regards to this, the chances are that the taxman will actually deny the claim altogether. So certainly definitely worth your while to have some records there available for us, and what we sort of encourage is the more records that you keep, we can help you make that assessment in terms of whether you can claim that as a tax deduction or not. So it can certainly lead that towards us, and we'll help you out in that regard. And in terms of other records, we get clients asking us, well, how long do I need to keep my records for? So the general rule of thumb is that you will need to keep your receipts for 5 years from the date that you've lodged your income tax return. Now, there are some exceptions to that when it comes to things like record keeping for items that have been claimed under depreciation methods or capital gains tax records. But certainly the general rule of thumb is to keep those records for 5 years. Now, the benefits of good record keeping is that in the event that the tax office do potentially audit you and there is a dispute upon your claims, then by keeping adequate records and having a basis of essentially including that claim in the first place can minimise any shortfall fines and penalties that can be put on top of any shortfall of tax that is assessed in regards to a change in your assessment. So again, a bit of a safe harbour for taxpayers is essentially the tax office saying, if you've got the records there and we potentially deny the claim, then we will sort of give you a measure of protection there in terms of some of the excess fines, which can be quite high, ranging from 25% penalties of any shortfall tax to a lot more higher than that, depending if there's recklessness involved. So yeah, essentially number one take from this discussion will be records, records, records. So finally, another topic that I'll be discussing is the shared economy or sharing economy. And often people are now becoming involved in this aspect of things. Particularly it's become quite popular with those who are wanting to seek an additional income, or even for some who are wanting to be involved in these services as their main source of income. Now, what is the shared economy examples of this? Many have probably stepped at the airport and hopped into an Uber. That is an example of a shared economy. If you've used Airtasker, that is also an example of a shared economy. Airbnb, for instance, is also part of this. And even something as simple as Uber Eats will fall under this sort of system. Now, often people who engage in these services as a business think that it should be relatively streamlined, straightforward. They've got very relatively simple tax affairs, but the reality is that it's not that simple when engaging in these services. Why do we say this? Well, because you're involved in a business, you'll need to consider whether you need to have an Australian business number, ABN, which is a requirement in engaging in these services or providing these services to the public. So certainly we can give you advice on that front there and assist if you need to make a registration on that front. Also, in addition, other implications need to be considered, like, do I need to register for GST? Do I need to have regular business activity statements prepared? What are some other registrations that could be if you're looking to seek to employ people within this sort of aspect of things? Then you may need to register as an employer as well. So as you can see, being involved in the shared economy does require some level of planning and advice, just to make sure that you can get it right and know that you're being compliant with tax office in this regard. If you need assistance on that front, please feel free to see one of our tax specialists.
Hi, I'm Mark. I'll be covering off on motor vehicle deductions and novated leases for you today, having a little bit of a look at the deduction methods, a bit of record keeping, what are the differences between the two, and then having a look at novated leases and what would make it attractive to you. Firstly, with motor vehicle deductions, up until now we've been working with cents per kilometre method and the logbook method. If you're not wanting to prepare a 12-week logbook, it's often easier to just do the cents per kilometre, and that's just recently increased from 1st of July to 68 cents per kilometre, but you are of course limited to 5,000 kilometres for the year. So if you are doing a great deal of travel for work, it's often a good time to look at doing a logbook. You may get a bigger deduction and obviously a better refund for you. And that's where we can help you look at what are the records that I need to keep to get a better deduction and consequently a better refund for my tax return each year. Record keeping requirements, they're fairly minimal for cents per kilometre. If you've got a reasonable estimate of what kilometres that you do on a weekly basis for travelling for work purposes, it's relatively easy to do, but of course you are limited to the 5,000 kilometres. When you get to the logbook method, you need to keep track of not only your fuel costs, if you've had some repairs and maintenance to your vehicle during the year, and of course if there are any other major items like buying a new vehicle and substantiating the finance that you're able to pay upon the vehicle, whether it's a lease or a chattel mortgage, and then we also calculate depreciation upon that vehicle. So it can add up to quite a large deduction for you if you are doing a lot of travel for your own work purposes. With a novated lease, that can often be attractive when you're moving to a new employment. Employers don't often want to have to invest in a car, which if that employee then decides to move on, they're left with that car. So you can bring your own car into a new employment, and then the employer can take up the responsibility for paying for that finance for you as part of a salary package. Now that's where, certainly here at DMCA, we can add quite a bit of value in having a look at what you are doing with your own salary package, and if you're able to use a novated lease or a chattel mortgage as part of that salary package and get a vehicle as part of your overall remuneration, that can work out quite tax effectively for you, because the impact of not only the deduction of the vehicle but also the GST can provide a good overall result for you tax-wise. With a novated lease, essentially you're the one that's contracting to the finance company, but when you move to a new employer, you're passing on the responsibility for those payments to that employer. They're relatively straightforward and they're quite commonplace, but it depends up to your employer if they're happy to provide you with a motor vehicle as part of your overall package. I want to talk to you now about selecting the correct ownership structure for you and your business. As you sort of form a business, start to go out on your own, you may be thinking, what do I need? There are a variety of different structures that you can use. There's the sole trader, where you operate the business under your own name. That's the simplest and most cost efficient of all structures. But as you get a little more complex and you want to involve family members, or perhaps you want to involve other people that you know and have worked with before, there might be other structures that would be more appropriate for you. So you might look at a partnership, you might look at a trust, or ultimately you might look at a company. All of these can be a little more complicated and require some good advice from your accountant, so would be a good opportunity to talk to us here at DMCA before you get going, just to see what's going to be most appropriate for you. You might want flexibility in your income. You might want asset protection for the wealth that you are going to build up. It may be such that you are entering into what can be a risky business, such that if something does go wrong, creditors might want to come and take your assets. So asset protection can be an important part of setting up the right structure. But most importantly of all, we're here to help with your goals and aspirations for you and your business, and this can be very important when trying to determine what's going to be the best structure for you. If you get one particular structure which is suitable at the start of your business career and your working life, that might not necessarily be what's the correct one for you in 20 years' time, when perhaps you're starting to slow down and wanting to pass it on to other family members, or ultimately even sell it to somebody else. So all of these things need to be considered when you initially form the business, what you're able to afford, what different elements that you require. Simply thank you for watching all of our various topics today, and if you'd like to get in contact with us here at DMCA, please give us a call on 8272 5620, or alternatively send us an email with any questions and we can arrange a time to catch up with you.